Hey everyone, this is Mark Treichel with another episode of With Flying Colors. Last month at its April board meeting of one. Remember, we've got one board member, Kyle Hauptman. No news on when his replacement is coming. I've heard some rumors, but until we have facts, I won't report it here. But at the NCUA board meeting in April, they did several briefings, one of which was on the NCUA strategic plan. And this is the 2026 to 2030 strategic plan. And I'm going to compare this plan to what the last plan had in it, which was 2022 to 2026. I've got a couple slides here I'm going to blow through pretty quick, and then a couple other highlights that I want to hit relative to this. But there are substantial changes, as you would expect, since the 2022 came out under the Biden administration, and the 2026 came out under the Trump administration. I'm drinking from my Believe Sasquatch cup here. And again, if you're going to believe what NCUA is saying in this document, there's a lot of changes that they're building into the next 5 years. All right. And this next screen, there are 12 plus 3, 15, 19 items that are supposed to be in the plan according to A11. 12 of them were fully met, 3 of them were partially met, and 4 didn't appear in either plan. And I'm not going to get into those because there's some side documents where these items may have been done, and really it's not that important because what is there's a lot of meat in the first plan, and there's a lot of meat in the second plan, and I'm going to compare those plans. And first, so what was in the 2022 plan, the 5-year plan, that's not in the 2026 plan? Number one, there was an economic outlook section. There were 8 pages of that, which included gross domestic product projections, unemployment forecast, yield curve analysis, interest rate outlook, which is now replaced with a very brief external factor bullets for each goal. There was a section on credit union system risks that were detailed near and long-term risk analysis, interest rate risk, demographic, fintech competition, concentration risk, management succession, which was a big issue for Harper. And this is now reduced down to a bullet list. There was a section on climate-related financial risk. There was a dedicated subsection and explicit strategic objective 1.4, objective 1.4 in the 2022 plan, and that's not mentioned anywhere in the 2026 plan. Why is that? Democrats believe in climate-related financial risk, and the Republicans tend to view that as something that isn't anything they should be getting involved with. That's why it is now absent. Agency programs narrative, there were standalone sections on AMAC, supervision, insurance, consumer financial protection, credit union development, and those are now folded into objective narrative. So that appears in different places, but with less words tied to it. I got to move my little thing here. Small minority, low income credit unions as a standalone objective. Goal 2.2 explicitly named minority depository institution preservation, CDRLF grants, and minority CU chartering. Those are now folded into broader access framing. But it's also more of a D initiative than an R initiative, which is why it would fall out of the plan for the next 5 years. And again, by the way, within a year of a new president coming in, the agency is supposed to have their new plan, the new 5-year plan put in place. So if we roll ahead, 2028, we will have a new president. And if it's an R, that R will have a year from that point in time to issue a new report. If it's a D, they will have a year to issue a new report. And you can imagine if it's a D, they'll run faster to achieve that than if it's an R, because the R will have similar goals and objectives, most likely under the next Republican, if that's what happens in 2028. But if you pivot to 2028 being a D, you'll see quicker movement. And by the way, NCUA was 2 months late from the required action timeline. I'm sure that they got a blessing from the powers that be in government to not get it done on time, because there's so much going on in the way that the Trump administration is getting rid of regulations, getting rid of requirements. I'm sure they really didn't care that this strategic plan was 2 months late. It was more important to them what the chairman was doing in office as opposed to what the plan said he would do. All right, next up, diversity, equity, and inclusion language. 2022 Goal 3.1 centered on diverse workforce and inclusive environment. They replaced that by merit-based hiring in 2026, which is consistent with the D versus the R slant on the importance of diversity, equity, and inclusion. Enterprise risk management section. There was a full ERM section with risk appetite statement, risk tolerance, portfolio views, governance structure, now referenced only briefly in the annual performance plan, which was a separate item. So the annual performance plan, each year NCUA has to issue an annual performance plan where they say, here's what we're going to do relative to our strategic plan. So it's referenced in the annual performance plan. I'll probably do a separate podcast on that. All right, cross-agency collaboration section, dedicated section on FSOC, FFIEC, the FIBIC with narrative explanations, now one sentence in the agency overview. I think that's probably a good change. A little less verbiage on how the agencies will collaborate, which is kind of a given. So next up, we have what's in 2026 that's not in 2022. So what's going on in the world that wasn't really going on so much in 2022? That's artificial intelligence, right? So AI is a standalone strategic objective in the new plan, objective 1.3 dedicated to AI. They talk about having a large language model pilot, an AI steering committee at NCUA, an AI roadmap with milestones. 2022 mentioned technologies, but not a standalone AI objective. Now, a little bit more detail on what's in the report. As I mentioned, the 2022 plan mentioned technology in passing. It was folded into a broader objective about delivering improved business processes. In 2026, AI gets its own objective, which makes sense because it's kind of taking all the bandwidth in the market, all the bandwidth when you are out there just watching anything, right? AI gets top priority. So it gets its own objective and it comes with actual deliverables. They're going to deploy a new data-driven risk model. They're going to complete a large language model pilot program. They're going to establish an AI steering committee, as I mentioned, and refine an AI implementation strategy, all by the end of December 31st, 2026. This isn't aspirational language. These are performance indicators they'll be held accountable to in the annual report and the everything that they do going forward. So what that means practically for credit unions is that examiners are going to start using AI-assisted tools to scope exam programs before they ever walk in the door. The question for you that you should be asking, what does my 5300 data look in the algorithm, right? Because they'll be looking at outliers. And I've been doing a lot of analysis of 5300 data to look at my own outliers for running my business and working with my clients or past clients or just podcasts, right? But this is going to get a lot of play over the next year. Of course, now you've got Hauptmann leaving, a new person potentially coming in. And I think that them hitting that 2026 deadline for all practical purposes is going to be a challenge, but it's an aspirational goal. And I'm sure that new chairman, when they come in, are going to go, wow, there's a lot of things I've got to get done here. And again, when do they come in, right? Do they come in September? Do they come in October? Do they come in next week? Time will tell. So next up, Stablecoin Genius Act as a performance target. They're planning on issuing a final stablecoin regulation by year end. First time digital assets appears in a concrete, measurable deliverable. So it's the clearest signal of where Hauptmann's head is at. And when he's out talking, he talks about stablecoin. And here it's embedded as a performance indicator in the annual performance plan. To issue final regulations on permissible stablecoin activities for all federally insured credit unions by the end of 2026. There's also a proposed rule open right now on the application process that closed April 13th, and a second rulemaking on issuer standards coming soon. For most credit unions, this feels very distant, but for larger ones exploring digital payment rails, this is a regulatory green light that you've been waiting for. And NCUA is committing publicly to get it done this year. Again, we'll see if they're able to do that. Now, NCUA's reorganization is codified as a strategic objective. Here's really what's significant about this. The reorg is no longer an internal management decision. By putting it in the strategic plan as objective 3.2, NCUA has made its 5-year commitment with performance accountability. The language is specific: consolidate major business units, group similar roles and responsibilities, eliminate non-statutory functions, and shift stakeholder-facing work to the regional offices. That last piece, shifting stakeholder-facing work to the regions, is the one that should get credit unions' attention. It suggests that whatever offices currently handle outreach, policy engagement, or member-facing activities at the headquarters are going to move back to the regions. So when I hear this, I think about field of membership. I think about bylaws, things that were done in access, the access office cure, that will now probably be pushed back towards the regions. The reorg plan won't be finalized until the end of 2026. Implementation runs through 2027. The National Treasury's Employees Union is still in impact bargaining, the impact on the workers, but this is now officially on the record. Now, I've criticized NCUA for not making their plans public. I know that they told their staff at the end of the year, for example, that ONES is going away and other things are happening. I think it's not very good use of the sunshine laws. And I think they talk about, well, we got to negotiate with union. I think that might be a delay strategy so Hauptmann doesn't have to take the final action. He proposed these broad sweeping things, but he's going to leave that for the next round. And whether that's 1, 2, or 3 board members, right? Because there's still the lawsuit of Harper and Oatzka. But changing regulations that say the Office of National Exam and Supervision exists to do A and then having them do B is something that if I was a single board member and it was not really clear whether or not I could or couldn't act, it's probably something that I wouldn't be comfortable finalizing all by myself. So I think it's wise to wait, but I think it's also creating morale problems at NCUA because they hear it's going to happen, then it doesn't happen, and it's creating a little bit of chaos at NCUA in my mind from what I'm hearing in credit unions and what I'm hearing in some conversations that the agency is having. So next up, real estate footprint reduction, reducing costs, eliminating underutilized space, maximizing shared federal workspace. There was no prior plan addressed for a physical office strategy. This one, it flew under the radar when they talked about it, but it's in the strategic plan, aligning the agency's real estate footprint with mission and workforce needs by improving utilization, reducing costs, eliminating underutilized space, and maximizing shared federal workspace. We know NCUA sold the Austin AMAC building. We know the Alexandria headquarters lease situation has been discussed. This language is the strategic cover for whatever real estate decisions are coming. For credit unions, it matters because office footprint decisions affect where staff are physically located, which affects examination logistics and regional presence. So there's a regional office in Alexandria. When I became executive director, previous board chair, and the board chair at the time, Debbie Matz, had moved Region 2 at the time, which was Alexandria, across the street. When I did a reorganization that closed Albany and closed Atlanta, I also moved that office back into the regional office. Now, with NCUA not requiring full-time, with NCUA doing more remote work, you could say that maybe they'll end up selling that building. But from what I see, buildings selling in that area is probably worth half of what it was worth maybe 5-10 years ago. But in any event, they do have an item here on making sure that they minimize their real estate footprint. Next up, we have merit-based hiring plan as a deliverable. The APP indicator number 22, implement the 2026 staffing plan aligned with the merit hiring plan. This is direct DOGE and executive order compliance language dropped into the credit union regulator's performance plan, NCUA. What it practically means is that NCUA is rebuilding its workforce under a different philosophy than it operated under for the past decade. It took out the voluntary plan, the VSP, took out 1 in 5 employees, and it was actually closer to 27%. The people being hired to replace them, if they're being replaced, will be selected under merit-based criteria tied to mission-critical skills. For credit unions, that means examiner listings will look different over the next 2 to 3 years. Whether that's more or fewer examiners, more specialized or more generalist remains to be seen. I know they're working on that. The reality is they're going to have a smaller footprint. And this is really a de-emphasis of DEI and an emphasis of hiring the most talented person for a position. And you can get into the debate of if DEI is good or bad. I'm not going to touch that third rail here today, but there's a definite pivot away from DEI. Deregulation quantified as a target. So this is the one that I think Hauptmann's probably really proud of. From an accountability standpoint, the performance indicators say issue at least 30 regulatory actions or policy revisions that reduce burden by December 31, 2026. Hauptmann said today that they're already at 29 proposed rules in phase one. They just came out with one this week, so they must have hit their 30. They announced the 10th round, and phase one runs through year end. That means by the time you add final rules in the second half of the year, they'll likely blow past 30 because they proposed 30 changes already. But here's the nuance: a proposed rule counts, a final rule counts, and a policy revision counts. So this number is achievable without necessarily finalizing anything significant. Watch the quality, not just the quantity. Happy to glad is not really a change. Now, they did make some changes that made sense, but most of the 30 that are out there are budget dust, if you will. Really don't amount to much, but it's a good banner for Hauptmann to be able to wave, saying, look at what we've done, Mr. Trump, President Trump. Chartering automation target. Indicator number 14, deploy an automated chartering system with 50% fewer sections for new charter phase one applications by December 31, 2026. Hauptmann is big on making it easier to get a new charter. They just shut down a new charter that they conserved. They chartered it and conserved it, I think, within 2 or 3 years and liquidated it. The current chartering process is notoriously cumbersome, and NCUA has historically approved very few de novo applications. I think it's all good to make things a little easier to get a charter. My thoughts are put a lot of charters out there. If they lose a little bit of money, so be it. But getting new charters out there is a good thing. But really, it's not a panacea because every industry consolidates. But I think having a lower burden to get a new charter out would be a good thing, whether you're a D, whether you're an R, whether you're an independent. Supporting programs bulleted per objective. So this is one of the less exciting items to talk about. But it's worth a mention if you live and breathe strategic plans. The 2026 plan actually does something the 2022 plan didn't do as cleanly. It lists specific programs and initiatives under each objective that support it. That's an A111 requirement, and the 2022 plan was somewhat vague on it. This is, in narrow respect, a restructuring that was probably driven by the experts at NCUA who said, hey, we should have done this last time. Let's put that in here now. All right, so next slide. The takeaways for the credit unions. Number one, reorganization is a 5-year strategic plan. Reorganization is now a 5-year strategic commitment. Number two, safety and soundness is the explicit North Star. It always is. Number three, AI and examinations is coming and will be measurable. Number four, NCUA has a deregulation scoreboard, which is a good idea, although most of what was deregulated really was not much of anything to speak of. There were a few good things, and I've got separate podcasts on the ones I thought warranted it, like a podcast on the proposal to change the limit on participation loans, auto loans. All right, so there you have it. NCUA strategic plan is out there. AI is big. The reorg is big. Safety and soundness is still important, although they're doing it with 27% less staff. And when you have less staff, you can spend less time on site. That could lead to more losses. That could lead to more fraud in credit unions. But in the end, in the short run, if less people are coming to your credit union, I'm sure if every credit union believes that that's a big win from the reorg, and now it's built in here to the strategic plan. All right, that's it. This is Mark Treichel. I want to thank you for watching. I want to thank you for listening. I hope you'll do the same again soon. Signing off with flying colors.